You think putting 20% down is always the smartest move? Let me show you why a smaller down payment could actually save you money. Hey, it's Steve Conti, your mortgage loan advisor. And today we're diving into a topic that confuses a lot of home buyers: mortgage insurance. You might think that putting 20% down is your best bet to avoid it, but that's not always true. I've seen situations where putting just 15% down can be more beneficial, and I want to walk you through one such scenario. Let's say you're looking at an $800,000 home. The common advice is to put 20% down, which would be $160,000 to avoid paying mortgage insurance. But here's the twist. What if you could save on your monthly payments by putting down just 15% instead? With 15% down, your loan amount would be $680,000. And your interest rate, about 6.875%. Even with mortgage insurance added, your monthly payment, including principal, interest, taxes, and insurance, would be approximately $5,557. Now, let's compare this to the 20% down scenario. Here, your loan amount would be $640,000, and you might expect a lower interest rate, right? Not necessarily. In some cases, the interest rate using 20% down could be higher, like 7.125%. This means that your monthly payment could actually be higher despite putting more down up front. Plus, your cash to close jumps to $160,000 compared to just $120,000 with 15% down. Now, let's take this a step further. There's a strategy called recasting that can maximize your savings. After you close on the house with just 15% down, you have the option to put more money towards your balance later, say an additional 5%, to reduce your mortgage balance and eliminate mortgage insurance. The beauty of recasting is that it allows you to keep your original lower interest rate from the 15% down scenario while benefiting from a lower loan balance. Here's how it works. After closing, you call your lender and ask to recast your loan. This process typically involves a one-time payment to reduce your principal balance, and it recalculates your monthly payment based on the new lower loan balance. But you get to keep that favorable lower interest rate that you locked in initially. So you've effectively lowered your monthly payment and increased your equity, all while avoiding the higher interest rate that may have come with a larger down payment initially. This strategy isn't without its caveats though. Not all lenders allow recasting, so it's crucial to confirm this option before closing on your loan. Additionally, this approach is primarily effective on conventional loans. It doesn't work as well with FHA loans, where mortgage insurance is required regardless of your down payment size, or with jumbo loans, which often have more strict requirements. Now, let me give you a quick example to illustrate exactly how this plays out. Imagine you go with the 15% down option. Your initial loan amount is $680,000 with an interest rate of 6.875%. After some time, you decide to go ahead and put down another $40,000, reducing your principal to $640,000. After recasting, your monthly payment drops, but you still have that lower interest rate that you initially got when you closed on the loan. Now let's compare this to someone who uses 20% down from the start. Their interest rate might be higher, maybe 7.125%. And even though they avoid mortgage insurance, their monthly payment could be higher than yours, despite having the same principal balance after you recast. This is where the strategy really shines. Lower monthly payments and more cash flow, all while building equity in your own home. Some of you might be wondering, what if I can't put extra money down later? Or isn't it risky to rely on recasting? These are valid concerns, and recasting definitely isn't for everyone, and it requires careful planning. The key is to understand your financial situation and have a solid plan in place. If you're confident that you'll have those funds available later, recasting can be a powerful tool to maximize your savings. Also, keep in mind that recasting is very different from refinancing. With recasting, you don't need to go through the entire loan approval process again or pay closing costs. This is simply a recalculation of your monthly payments based on the new principal. But if your lender doesn't allow recasting, this strategy won't work for you, and you'll need to consider some different options. So is this strategy right for you? It all depends on your financial goals and your personal situation. If you're interested in exploring this further, I'm here to help. Click the link in my bio to schedule a chat, and we'll go through your options to see how you can make the most out of your mortgage. Don't leave money on the table. Let's strategize together and find the best path for your home financing journey.